Welcome to another edition of our Money Talks videocast. I'm Jerry Slusiewicz, your host. We update these things generally monthly, or if there's any significant changes in our market outlook. Today is Tuesday, May 17th, and what we're looking at right now is a potential change in direction on the market. Hasn't really happened. I mean, it has for commodities, that's for sure, but on the stock market, the rise in the dollar over the last couple weeks is causing commodities and basically all assets that are priced in U.S. dollars to be revalued. Remember, the dollar is the world's reserve currency. So all across the globe, things trade in dollars, whether that's oil or gold, silver, or even the U.S. stock market are priced in dollars. So as the dollar has been declining over a period of time, everything else has been rising in relation to that. Now granted, there's supply and demand and traders in the economy, etc. But economically, things aren't really improving fast. They're improving, but they're more plodding along, kind of bottoming out, rocking along. Housing is not. Housing pricing is continuing to decline. Pricing of houses nationally has dropped lower than it did back at the lows of 2009 and appear on the verge of a double dip. The stock market still is holding up because of good earnings from the last earnings season, but we're now heading back into the summer months, which is seasonally, traditionally, a harder time for stocks, and year over year, it's going to be much more difficult with the earnings comparison. Just today, for example, Walmart came out with their earnings, and their same-store sales were down 8 quarters in a row. So they're building more Walmarts to help their earnings meet expectation, but the Walmarts that have been in existence for more than a year are not selling more goods. So the middle class and the working class are having a more difficult time keeping up with their lifestyle. Yet, again, it's a situation where the rich are getting richer. If you look at some of the higher-end stores, retailers, Tiffany's, Macy's, Nordstrom's, you'll see that those stocks are doing well, retail's doing well. But what's happening is the cost of gas, oil, commodities, higher food prices has eaten into people's discretionary spending. On average. Again, it doesn't affect the wealthy as much. So we're very concerned with the ending of the quantitative easing. A lot of people aren't aware, but the Fed has been pumping in an average of $4 to $5 billion per day since the 1st of November into the system. That's set to end at the end of June. The training wheels are going to come off the economy. We'll see if the economy is going to stand on its own, which we hope it does, or if it's going to slow down and fall. Some of the early indications don't look that good. It's a very good time to be defensive and to be concerned about your positions and use stop losses. Like I said, we've gotten rid of most of our commodity positions. We've increased the amount of bonds we've held, although I will caution on municipal bonds, not individual bonds, but municipal bond funds still hold inherent risks. If you have some individual bonds, it's always a good time to get those reviewed as well as any stock positions. It's not what you make, it's what you keep. A lot of people have done very well on this recovery over the last couple of years, but it's just a matter of after this nice run, are we going to consolidate and go sideways? Are we going to get a little bit of a pullback? Time will tell, but it does appear that some of the economic numbers coming out show more weakness recently, and the fact that commodities and things are dropping with the rising dollar, that could affect the stock market as well. You see the foreign markets performing poorly. We see problems in Europe coming back. Greece looks like they're in need of another bailout. Portugal just received a $110 billion bailout. Ireland wants to renegotiate terms. Spain and Italy still aren't that strong. So old problems are new and new problems are arising. Very important to pay close attention. The stock market has held at the 50-day moving average. We'll see if we get a rebound here. If we take out the more recent highs, I think we'll go back to the '07 highs on the NASDAQ or on the S&P and the Dow. The Russell 2000 Small Company Index already has done that. But things are not quite as good as they look on the surface. A look underneath is flashing caution, and I would express caution to you today. Call for a free, no obligation portfolio review, toll free 800 800-449-9501. Sign up for my free email newsletter. It's right up above under free educational newsletter. Send out a podcast or an article at least once a week. Toll free 800-449-9501. Or again, sign up for our free newsletter and we'll get you on the list with no obligation. Have a great week of investing.